So we are going to go ahead and get started. Thank you for joining us this morning for the webinar, Leaving New York and Saving Taxes. My name is Elizabeth Aloni. I'm with ChFC Media. ChFC Media is the largest local media company in the New York metro area. We publish over 70 newspapers, magazines, websites, webinars, podcasts, and events, and do so throughout Queens, Brooklyn, the Bronx, Manhattan, Westchester, Long Island, and Philadelphia. Today, we're going to talk about a very important topic. If you're thinking about changing your domicile to a no tax state like Florida, Texas, Tennessee, or Nevada, and we're going to speak with experts who are going to give you the facts and the solutions. Let me introduce you all to our panelists. First, let's welcome Karen Tenenbaum. She's a tax attorney and accountant. Karen has been an attorney for over 35 years and founded Tenenbaum Law PC, which helps individuals and businesses facing IRS and New York State tax problems. Welcome, Karen. Tell us a little bit about yourself.
Thanks, Elizabeth. Thanks for having us. I'm so excited about today. This is such a popular topic. So I'm Karen Tenenbaum, Tenenbaum Law, as you mentioned. We're tax attorneys in Melville, Long Island. We help people who have tax problems. If you get a notice from the IRS or New York State, we handle the residency audits, the sales tax audits. If you owe money, we help you get an installment agreement, get penalties off. If you think you owe less than you got in the notice, we handle offers in compromise, innocent spouse, anything relating to IRS or New York State tax problems.
That is a big weight off one's shoulders to know to call you when you get something from the IRS. Thank you so much, Karen. Welcome. Now I want to welcome Andy Presti. He's the managing partner at Presti Naegele. Andy, please tell us about yourself.
Had to unmute first. Yeah, so I'm a partner in an accounting firm in New York City. Been here about 40 years. We handle individuals, businesses, and we're a full service accounting firm. I don't want to be long-winded.
Well, thank you. That is perfect. Last but certainly not least, I'd like to introduce Eric Donner. He is the co-founder of 6 Months and a Day. Eric is an entrepreneur and financial and business advisor for over 35 years. Eric, please share with everyone about yourself.
Thank you, Elizabeth, and welcome. Good morning, everybody. I'm Eric Donner. Very, very happy to be here. As Elizabeth said, I've been advising clients for over 35 years in financial, tax, business areas. I've had offices all over New York, New Jersey. About 10 years ago, a light bulb went off and I said, hey, let's move to Florida. And as you can see, that's my backyard. No, it's not, but not pretty close to it.
Nice.
And so, we've had a lot of clients from New York to Florida over the years, and it's just something that has come up. So my son and I built out a company. We have software, which we're going to share with you today, something to really help provide the taxpayer with a good defense.
Fantastic. So it's not just problems, but it's also solutions. We're really looking forward to that. So I am going to go ahead and share my screen. And Karen is going to get started with her very important presentation and our conversation about it. So Karen, share with us a little bit.
Slide. So I always start with a general disclaimer that the law is fluid, it changes on a regular basis. So this is really not legal advice, but again, just highlighting the problems and hopefully giving some help along the way. Next slide.
So tell us a little bit about how COVID has affected things.
Okay, so most people think they know where they live. When I do a live presentation in front of hundreds of people, I say, raise your hand if you know where you live, and everybody raises their hand. And then after a while, when I go through the details and they realize how complicated the issue is, at the end I say, raise your hand if you think you know where you live. Crickets, nobody raises their hand. You'll first realize that this has really been highlighted during COVID because it's impacting that many more people. So years ago, when they changed the federal law to limit the state and local tax deduction and capped it at 10 grand in New York, for New Yorkers, that's every New Yorker said, oh, I'm moving. But did they really? But when COVID hit, a lot of people finally said, you know what? I'm moving. So they said, either I'm going to live in my vacation home, maybe out in the Hamptons if they were once in New York City, or I'm going to go visit my parents who live in another state, or maybe they were never thrilled. They always wanted to be in Florida, and they said, you know what, now's the time. So I'm going to Florida, I'm staying there, or they were there and they couldn't come back, or they came back to help relatives. So all of these issues came up during COVID, and a tremendous amount of people actually moved out. But did they move out permanently, or is it temporary? And so what we're going to see is New York State is going to come in and say, you know what, we don't think you really moved. And they're actually already sending letters for people who filed 2020 tax returns just recently. And they're very different than the prior letters that you used to get. They're desk audit letters. And the letters are saying, maybe you made a mistake. They don't use those exact words, but they're questioning. We know that perhaps you once lived here, and now you think because you maybe worked remotely from another location that you might not owe tax to New York as a resident. But guess what? Think otherwise. And now they're attaching a questionnaire. They normally attach that questionnaire when they're doing the full-blown audit, or they're about to do a full-blown audit, a field audit. Now they're doing it with a letter. So it's quite interesting to see the shift, and so quickly, because so many people are going to have this exact issue.
So how does New York define residency? I think that's a helpful way to get started.
So I think the real question is, why do we care about this whole topic? Because New York State taxes a resident, if your taxes a resident, on one thing, and that thing is everything. No matter where your income is earned, New York is going to tax you if you meet either the domicile test or the statutory residency test. Now, right now, we're focusing on income tax. If you're looking at estate tax, we only care about the domicile test, but we're not going to look at that piece right now. Today, we're only going to look at the income tax aspect, and both tests are very important. So the domicile test is really where's your heart? Where's your permanent place that you intend to return when you come home from vacation? Where is home? The statute, and that's, by the way, very subjective, and we're going to go through that. And because it's subjective, New York State looks at objective factors, and we'll go through those in a minute. But the statutory residency test is very basic. Do you have a permanent place of abode that you've maintained for substantially all of the year in New York? And did you spend more than 183 days in New York? If you meet that test, you are taxed here unless you meet one of the exceptions. Okay, next slide.
The domicile test. Can you tell us?
Right, so this is what I just said. It's your true and fixed permanent home. Where do you intend to return to? Next slide. So how do you change your domicile? So you can only have one domicile. You can have many residences. So you could have a house here, a house there, a house somewhere else, but there's only one tax home, and that's your domicile. That's where you're domiciled. And you have to, in order to change your domicile, you have to leave, abandon it in effect, and land somewhere else. Leave and land. Now, when I say abandon, you don't have to give up every single thing in New York, but you have to show that you've changed your pattern and your lifestyle. And again, we're going to go through the factors in a minute that show your intent. Domicile, the burden of proof is on the person or the entity changing that domicile. So if you are always in New York and you're leaving New York, you have the burden of proof as the taxpayer. If you were always somewhere else, let's say Florida, like Derek Jeter, and you're moving into New York, or New York wants to claim that you've moved in, the burden of proof would be on New York. Once you change that domicile, it's changed until it changes again. The statutory residency test is determined annually. That day count is annual, every single year. If you have a place here, you never got rid of your home, and every year you spend more than 183 days here, you're still going to be taxed here as a resident.
Good to know.
The key is really to establish ties in the new place. Next slide.
Okay, talk about our primary factors.
Exactly. So how do you show intent, right? They came up with 5 objective factors and they weigh them. So they're comparing New York to where you claim you live. They're going to look at your home. They're going to look at your business activities. They're going to look at the time spent, and this is not the 183-day rule everyone thinks, and that's why Eric's 6 months in a day company is providing a very great service, because everyone thinks it's 6 months in a day, when it's really, first you got to get over this other hurdle. Items near and dear. So these are things, it could be, well, we'll go into detail in a minute. So items near and dear and your family connections. A lot of people think it's the other factors that matter. your driver's license, your voter registration, where you actually voted, your car registration, what you say in your estate planning documents. But the truth is, you have control over those things. So if you do them, that's lovely and great. But if you don't do them, New York State says, why didn't you do them? So if you do them, New York is like, okay, obviously you had control over them. Everyone thinks if I just change my driver's license and my voter registration, I'm done. That's not true. But you do want to have those factors taken into account, and you want to do them in consistent with the time you're claiming that you move. So if you say usually you want to pick a specific date and have a moving van, a moving company, take your stuff and move so that everyone knows and you have proof on the date you left. Because if it's a creeping change over time, you're going to have a problem. And there are a lot of typical scenarios. So usually people buy a place maybe years ago in Florida. So year one, they buy it. Year two, they renovate it. Maybe they decorate it. They don't need to move their furniture. They don't need to necessarily move their clothing. They buy everything new there. And then over time, maybe they get an art collection and then a wine collection, all in Florida. But perhaps they still have everything they had in New York. When did they actually move? What was the event that made the difference? And New York State is going to look for that event. So there's also a lot of non-factors that everyone worries about. You know, here, let's see. I don't even have the list of non-factors. Oh yeah, the where your burial plot is. You know, people say, oh, I used to worry about it. You know, I'm coming back to New York because I'm going to be buried there. They don't look at that anymore. And things like where your accountant is, that's okay as well. All right, next slide.
This is really important information to gain clarity on what's important.
But again, it's so confusing and it's so overwhelming. And if you don't know the specifics, you're going to definitely have a problem, because unfortunately, we get a lot of people who get advice from their professionals who don't necessarily know all the rules. So for example, I was once on a panel with an estate planning attorney from Florida, a very large firm, and he started listing all these other factors that I just mentioned, the cars and the registrations and things like that. And that's what he tells his clients. But guess what? I leaned over and I said to him, give every one of your clients my name, because you're giving wrong advice. Those are not the rules in New York. And if that's all they do, they're going to have an audit and they're going to lose, because you have the burden of proof. As I said, if you're the one claiming the change of domicile, you have the burden of proof by clear and convincing evidence. And so again, Eric's service is going to help you plan in advance to have all that documentation ready, right? So we just had a client who bought a house in Florida in year one, and in year two sold a $42 million business. New York State came in and sent him a bill for millions. Okay, he said, well, I moved before all of this and I don't owe you tax. And they said, prove it. Well, guess what? His professional handed over the buy-sell agreement and the 3-year contract that showed that he was then going to be working for the next 3 years in New York. Guess what? That's a problem. Right? So all the evidence has to point in the same direction on the same date. So it's not only did you move permanently? Because if it was temporary, like you just moved out to your house in the Hamptons because it was convenient during the pandemic, but then you're moving back to New York City, did you ever really leave New York City? No, New York State's going to have the benefit of hindsight to see what you did 2 or 3 years down the road. Usually they audit you for a few years. But just getting back to this fact pattern of the guy who sold the business, he didn't have any proof that he, other than, driver's license and car registration, that he moved in year one. So we were able to save him some money, but he could have saved a lot more had he planned in advance. So they take a look at your home. What kind of house do you have here? And what kind of house do you have there? They're comparing. It's a balancing act. No one factor is determinative. Now, what happened during COVID? A lot of people temporarily left their house here, or they were unable to sell their house here, or they couldn't move their stuff out from here, or they weren't able to use their house the way they would normally use their house. Mm-hmm. So perhaps this 1 year is going to be tricky for a lot of people. Next slide.
Business, this is important, your active business involvement.
Right, so they take a look at, again, it's a comparison, your day-to-day operations. How involved are you in that business? A lot of people claim that they retired, but because of COVID and they had 40 years of experience and maybe their child was running the business back in New York, they said, you know what? you have some more issues that maybe you didn't encounter before. I'm going to come and I'm going to help you deal with maybe the PPP loans, or I'm going to get more involved in the day-to-day operations. So even though I quote retired, maybe I'm really back and actively involved this year. And so that's going to be a problem. And also you want to establish a location. You want to open up an entity or have a lease in the new location so that you could say, hey, listen, guys, I'm really doing business here. This is not just all talk. I'm not just sitting in my bedroom claiming that I'm working, that I'm not working, or that I am working from another location. You want to show that you have a place with a lease, that you're paying rent, and it's a real business if you're claiming to be somewhere else. So we were on a Zoom earlier today with an attorney, who is only licensed in New York, but is now living in Florida. That's going to be a problem for him. If you're only licensed in New York, you're probably actively involved in a business in New York, unless you have some arrangement with a company in Florida that allows you to do business there.
So all those things are very important to think about. It's not just saying, oh, I have a phone number in this other state. You need to really set something up that shows truly there's a business entity there.
And again, you want a paper trail so that you could prove where you are.
Mm-hmm.
All right, next slide. So items near and dear. So, this is the dog, the dog case. So the CEO of Match.com, it's the Black case, lived in New York, loved New York, moved to Texas for a year and a half, and he brought his dog. Now, after a year and a half, he ended up moving back to New York, but they said he wrote an email at the time, oh, I'm finally moving, and he brought the dog. And they said that was enough. So it's not just the valuables, but it's also the sentimental things. And so I always say that the auditors usually have a little bit of tunnel vision. They're looking very closely at a piece of paper that helps your case or their case. And so a moving bill helps everything. It shows the date you moved, and you usually want a list of what you moved. And I would definitely recommend moving something, on a specific date, and have everything consistent with that. And then you want to change your insurance policies. So don't tell me you have all your valuables in Florida, but they're still insured in New York. Next slide. Now, during COVID, it was probably a tough time to move things, but you still want to consider it. Time spent. Again, this is not the 183-day rule. It's a comparison of how much time you're spending in New York versus your claimed new domicile. And so during normal times when you could take vacations, go to Europe, go on a cruise, they're looking at the New York time, let's say, versus the Florida time, but they're not counting all that other time that you're on the cruise and that you're in Europe. So a lot of people who have quote retired have all that extra free time. You really want to have more time, a lot more time in the new domicile than you have in the old domicile. And again, during COVID, a lot of people were stuck in one place or the other. And so I think that the timing issue is going to be pretty interesting to see. All right, next slide.
Like you said, time is not the only factor. There are all these other
right, but they do place a lot of weight on the time and on the moving bill and on the insurance. So you really want to look at those things. And then, of course, family connections. They usually look at where the minor children go to school. And now everyone was working and going to school remotely. So let's say you moved to Connecticut during this period of time. Did you enroll your children in a different school? And what did you do next year and the year after? Did you come back? Again, was it permanent or was it temporary? So next slide. So that's basically the domicile rules. So first, if you were always in New York, you're considered a New York domiciliary. You're taxed in New York on everything you have. And let's say you get over that hurdle. You've now shown through all these factors that you've actually moved. Well, guess what? You now have to get over another hurdle. And this is the 183-day rule that everyone talks about. So you need a permanent place of abode that's maintained in New York for substantially all of the year. And you spend more than 183 days in New York, but not necessarily at that location. So there's a famous case where a guy lived in Connecticut. No one disagreed. The Barker case. He was a hedge fund guy in Connecticut. He was a hedge fund guy, lived in Connecticut. He had an office in New York and a vacation home in the Hamptons. And his in-laws lived most of the year in that house in the Hamptons, and he visited it for a week or two over the summer. Well, guess what? Because he spent more than 183 days in his office in the city, it didn't matter that he didn't spend time at his permanent place of abode, which the Hamptons house was considered. He owed more than $1 million in taxes to New York, And because he didn't check the box that said, I have a permanent, they don't call it permanent place of abode on the tax return, they call it living quarters. He didn't check the box that he has living quarters in New York. They sent it back for penalties. So
Wow.
can you imagine? All right, next slide. So what does this mean? You know, any place could be a permanent place of abode. And the issues come up when you have relatives. So there's the famous Gayed case. So this guy lived in New Jersey, no question, domiciled in New Jersey. He had gas stations in New York, in Staten Island, and he had a 3-family house around the corner that his parents lived in. And they were elderly. And once in a while, they would say, honey, sleep on the couch. We don't feel good. He didn't have his toothbrush there. He didn't have everything hanging in the closet, all his clothes. And New York State came in and said, that's a permanent place of abode. You have a key. You could come and go anytime you want. And because you're at your gas station more than 183 days, we're going to tax you in New York. Well, went back and forth, back and forth. He won, he lost, he won. Eventually, he went to the highest court and he won. And they said, you have to have a residential interest in this property. You got to treat it like it's really your home. You know, you have to have, it has to be more than your parents' place. So we say that when kids graduate from college, a lot of them want to live in New York City. And a lot of the parents say, oh, honey, I'll be on the lease. I'll get that place for you, or I'll either lease it or I'll buy it. Don't worry. Well, if it's a studio apartment, you know, that's fine. But guess what? If it's a 1-bedroom or a 2-bedroom and there's a place for the parents to sleep, I've been involved in audits where New York State comes in and says, we think you live here. We had somebody who lived in New Jersey, was a professor at NYU, and got his daughter an apartment. And we had to prove that he didn't have the key really, and he wasn't at the closing, you know, that he doesn't live there. You got to take pictures of it. It becomes a hassle to get through. But any place could be, even a vacation home could be a permanent place of abode if it has cooking and bathing facilities and is available for year-round use. Next slide.
It's really important if you own property somewhere else, to speak to someone like yourself so that you know what you're doing with your taxes and the potential pitfalls.
Well, you can't believe how many people have this exact situation, telecommuting during the pandemic. They had a lease for an apartment in New York City. They worked in New York City. And then because of the pandemic, they went to their house in the Hamptons and they were working from the Hamptons. And then their lease was up, let's say September. So they moved in March of 2020. Their lease was up in September and they're not coming back. They gave up the lease and it's over. So the question is, well, when did they move? Yes, maybe they moved permanently. We'll see in 2 or 3 years. But when? So we had Joe Carzo, who's head of all of audit, on a panel at the tax symposium in November. And we asked him this exact question. And he said, you know what? It depends. So again, you have the burden of proof. So yes, maybe you move, but when? New York State is going to be auditing a lot of people. And so they changed their guidelines after the Gayed case. To them, I don't think anything has really changed. It's always been, do you have unfettered use and access? Is there a room dedicated for your clothes? Do you keep your toothbrush there? How do you prove these things? How do you prove where your toothbrush is and whether you have clothes hanging in the closet? It's a big burden. So, and do you contribute to the household? There was a case years ago, a guy, the Evans case, he lived in a church rectory, but he did go to work Monday to Friday. And I believe he helped pay for maybe either the food or the housekeeper, but he didn't have a lease and but he did have unfettered use and access. And they said that's a permanent place of abode. All right, next slide. How are we doing on time? So what is a day? I mean, honestly, any second in New York is deemed a day. So if you live in Connecticut and the closest place to go food shopping is in New York, or you pick up the babysitter in New York and go right back to Connecticut, that's a day. A second is a day. And so they have a limited exception if you're traveling just through the state to get to the airport or just through the state, or if you're an inpatient at a hospital for a medical treatment. But if you stop to eat and shop and do all these other great things, no. And if you're inpatient at a hospital, the days don't count for you, but they do for your spouse, which is unbelievable.
Oh my.
And so if you have any kind of medical treatment and they throw you out of the hospital in a few days because of insurance, guess what? Now you're sitting on your couch healing from a hip replacement. Those days in your New York apartment count. And so it's very easy to get to 183 days or over the 183 days.
Wow.
All right, next slide. So this is the exception that we mentioned for medical treatment. Let's go on. And so they look at everything. I always say it's like a colonoscopy. They're looking up your rear end with a microscope. And I'm not kidding. They look at everything. They subpoena your phone records. They look at your Easy Pass, the swipe cards getting into your building. It says I signed out. I don't know what this says. Wait, I hope I don't lose this. Okay.
Oh, you're good. You're here.
I just lost you. Okay.
You're here.
Okay. I'm sorry about that. They look at your calendar. They look at everything. And they go through all your credit card receipts. And there's a lot of false positives. You know, maybe you automatically on the 15th of every month have something charged. And so, but maybe that place is in New York, but they have locations all over. And so you really have to look at what's, where you are and how you're going to prove it.
Wow. This is more about
and the cell phone records. So they take a look at your cell phone records, and sometimes it's not accurate. They're looking at the strongest tower, not necessarily the closest tower. There are apps that have GPS, and that's probably a better guide. But this is what they look at. Okay, so wait, let's go back for 1 second.
Yes.
I'm back. Okay, so we have a free app. Everyone could download it. You could scan this QR code, and it's a tax helpline app, and it gives you links to all the New York State and IRS websites that are relevant and all the forms you need. So some of these things you could do on your own, but some of these things you need help with. All right, next slide.
What is the name of the app?
Tax Helpline.
Okay, and we're going to include this, everybody. We're going to include this in the email you get tomorrow, so not to worry.
Okay, and this is my virtual business card. It's pretty cool. It has links to my website and jingles and testimonials and other things. And the last page is really just my contact information. And you can call us anytime. I'm at Tenenbaum Law, LI Tax Attorney, Tenenbaum at litaxattorney.com. And you can always call us 631-465-5000. And I'm always available to answer questions.
And not to worry, again, as I said, we are going to send you all of that information. But my God, the amount of information you need to know, it's overwhelming. And it just goes to show you, even with the people that you meet with, that if you're not speaking with someone who knows about this specifically, you can be losing a ton of money. So really important that you have the right team with you, giving you the right advice.
And I have to just say that, again, it's very complicated. And again, if I ask now, do you know where you live? You would think you might know. If you bought a house in year 1 in Florida, in year 2 you did whatever, and in year 3 whatever, you'd be surprised in year 4 when New York State sends you a bill for $250,000 saying you haven't moved.
Wow, incredible. Wow, Karen, that really put a light on everything for us. I really appreciate you.
All right, thanks.
Yeah, so let's go to Andy. Andy, I'm going to share your information, and
Sure.
Andy is going to share with us how he helps his clients in this incredibly complicated world.
So thank you, Karen. And you know how when you go to see the Rolling Stones in concert, they usually put on a lead act that's sort of to warm the audience up? This is the exact opposite. Karen really handles the meat of this. If you're looking to change domicile, the points she's bringing up are the main points. I'm not going to go through them. I get the same questions from clients as an accountant. But if there's anything complex, we push it right over to her because she really deals with the rules and regs of getting you to be accepted as no longer a New York State or New York City resident. So what I'm going to talk about is why are we doing this? Well, you're doing this to save taxes, obviously, right? So the case we see a lot is people don't understand. So let's assume you jumped through all those hoops that Karen just said. And by the way, one of the most important things she said was you don't have to drop your New York accountant. So that's a good thing.
Excellent.
So let's assume you jump through all those hoops. You're considered a Florida resident. The purpose of this, obviously, is to be in a zero tax state and no longer pay New York taxes. But you have to understand there are certain incomes, even if you are deemed to be a Florida resident or a Texas resident or a Nevada resident. What is New York sourced income? Because you will continue to pay New York income tax on that income, right? So let's take the Connecticut, New Jersey situation closer. If you're still working in New York State, you're still going to pay New York State taxes on that income. You will get a credit in your home state, but you're not going to alleviate New York taxes by simply moving out of New York if you still work in New York on the wages that you've earned. That's a clear thing. Now, Florida is a little much, where if you move to Florida, are you still deemed to be working in New York? The rules can get kind of dicey. If the business's headquarters are in New York and you don't have any other business office in Florida, it's a bit complex. But in addition to getting New York to accept that you're no longer a New York resident, you're no longer domiciled in New York, both for the statutory and the domicile test, then New York's going to say, okay, you're a non-resident of New York, but we still want to tax you on the following income. So wages you earn in New York, some bonuses. People have planned that I'm going to move to Florida because I have a big bonus coming up, and New York can still deem that to be taxed to New York if they can prove that it was earned while a New York resident. Right. So you got to be careful. And I'm not going to get into many details here because it's very complex, these rules. If you maintain New York rental properties, if the main source of your income is rental income and you move to Florida, but the rental properties are in New York, that's still going to be taxed to New York. Stock options. A lot of people have moved out of state and then they exercised company stock options that had a large gain built into them. There are times where New York can say, well, the stock option, the value that you received while you were a Florida resident was earned while you were a New York resident. So they can come back and try to grab that. Same thing with some deferred comp payouts. None of these rules are absolute, where all deferred comp payouts are taxed in New York if you worked in New York. Really depends on facts and circumstances. Each one of these has their own nuances. Untaxed installment payments. Let's say you sold a property in New York and you held a mortgage, so you're on the installment method. You didn't pay capital gains tax on the entire sale. Well, moving to Florida is not going to alleviate the New York taxation on the profit on those installment payments that you receive. If you're involved in businesses, if you're a partner in a partnership, if you're a shareholder of an S Corp and you receive K1s, if the business is still sourcing their profits to New York, your K1, even though you're living in Florida, will have New York sourced income. Therefore, you're still going to have to pay New York non-residency tax. The New York non-residency tax rates are identical to the New York residency tax rates. So there's no reduced rate for a non-resident, other than you may not have as much income, right? So in general, when you're a New York resident, you're paying tax on your worldwide income to New York. If you move out, let's assume you get past Karen's hurdle and you are now a Florida resident, then the only income that's going to be taxed to New York State would be income sourced to New York, which are some of the items that I just went through here. And again, each one of these has nuances that are very specific to that category. But New York does not want to give up on taxing that income easily. Now, a lot of people that we've dealt with this year, it's not necessarily a move out of New York State, but it's a move out of New York City. New York City does not have a non-residency tax. So if you can show that you moved from New York City to Nassau, and again, you get past Karen's, test, but you still work in New York City, there is no New York City non-residency tax. So you will alleviate yourself of the New York City tax if you can show that you no longer are a resident domiciled in New York City. Right? So that's a good thing. So a lot of people that try to do this have their own businesses, right? And at the business level, well, what income is considered sourced to New York? Sourced to New York means New York is going to consider it New York income. So whoever the partners of the partnerships are, whoever the shareholders of the S Corp are going to pay New York tax on that portion of that K1 that they receive. Now, New York being New York, there are different rules, whether you're a partnership or a corporation. New York City I didn't get into that here, has their own set of rules as what's considered New York City income, what's considered New York State income. So let's start with a partnership. Let's assume you sell tangible personal property. You sell a product. New York considers that to be income if the shipment originated in New York. Now this is only for partnerships and LLCs, not for corporations, right? So partnerships and LLCs, you have a warehouse in New York, you ship all across the country. None of your customers are in New York. 100% of those sales are going to be considered to be New York sourced sales, which means that business, assuming it doesn't have physical locations elsewhere, is going to be 100% sourced to New York State. So even if you live in Florida and you're a partner in a partnership or a member of an LLC, you clearly never stepped foot in New York, but you own the business, and the business sources its income to New York, you're going to get a New York K-1, you're going to pay New York non-residency tax on that.
Mm.
So let's say that same partnership or LLC performs a service, say an accounting firm. New York deems services performed while in New York to control what is considered New York sourced income. So you could have clients all over the country, but if everybody's sitting in New York performing those services, it's going to be deemed to be New York sourced income. Now we get to corporations. Let's assume you own a C Corp or an S Corp, and that entity sells personal property. It ships a product. Corporations, you look to where the customer resides. So if you're in New York, everything is shipped from New York, but none of the customers are in New York. That's not New York sourced income for an S or C corporation. Exact opposite as partnerships, right? Similarly, if services are performed by a C or S corporation, it's where it's called where the customer receives a benefit. It's called market-based sourcing. It gets complicated if they try to determine that the customer received a benefit from services performed in New York, even though they're not sitting in New York, then it could be deemed to be New York sourced income. All right. So again, I don't want to get into a lot of details here. The whole premise of this is more predicated on the items that Karen spoke about, right? Because that's the first hurdle. But even if you're considering trying to get over that first hurdle, you have to really look at, well, what does that mean for me financially? If all of your income is still New York sourced income, it's pointless. Well, I don't want to say pointless because there are state issues, but you're still going to pay the same level of New York state income tax if all of your income is sourced to New York. Now, investment accounts, you could have a brokerage account at Merrill Lynch and capital gains, interest, dividends. That's not New York sourced income if you are deemed to be a domicile and resident of another state. Okay, so once you get past Karen's situation, which is the 98% factor here, it is important to understand, well, what does that mean for me financially? Everybody thinks, well, now I'm a Florida resident, I don't pay any state tax. Well, not if your rental properties are in New York, your businesses are still throwing off New York sourced income and you're a shareholder, you're receiving a K-1, you're receiving bonuses while you were a New York resident or working in New York. All of that is still going to be taxed to you. Still a good idea to become a Florida resident. You won't pay more tax, let's put it that way, but it may not alleviate all of the tax burden that you're currently dealing with. And just remember, New York City doesn't have a non-residency tax. So at a minimum, if you're a New York City resident and you go to Florida, you're going to save the New York City residency tax no matter what. That's a guarantee. But sometimes the New York state tax lingers because you have mainly New York sourced income.
So it's very important not to deal with that first hurdle, and then also make sure that you're speaking to an accountant who can help you with your specific business and where your monies are sourced, so you can have clarity around how your income is going to be taxed.
The way the typical conversation goes when a client comes in and says, hey, what would my tax burden be if I moved to Florida? Well, if there's no New York sourced income after that move, it's simple. It would go from A to B, from A to 0, right? But many times it's, well, if you did that, you would still pay on 90% of your income. They don't even attempt it because they don't want to go through the audit and have to, not that they don't want to deal with you, Karen, but they'd rather not, right? So they just don't want to go through the hassle if they're truly not going to save the dollars they think they're going to save. So it's sort of, let's understand what the savings would be and then go to the facts and circumstances and determine whether it's worth the move or not.
Fantastic. Thank you so much, Andy. That
You're
really
welcome.
shed light on it for sure.
Oh,
And
before you get to Eric, I just want to add one sentence. Andrew, that was amazing. I actually learned a lot because I handle things from the legal side, and it's nice to hear it from the practical accounting side. Everyone does have to say up front, are there any savings here? Because we've seen situations where people are fighting, and at the end, there wasn't any. You're right.
Right.
But I just want to say in the telecommuting world,
we'll be sharing Andy's contact information with everybody tomorrow as well. I'll put it in the chat too. But I don't want to make you all feel like, oh my God, this is gloom and doom. I want to get to Eric, who can share with us a little bit more.
But wait, before you get to Eric, I want you to introduce Eric in a minute, but I just want to say with respect to COVID and the telecommuting rules, this is really key because this is the question we're getting every single day. So if you are a non-resident of New York State, meaning you always lived in Connecticut, New Jersey, whatever, but you used to commute into New York, those telecommuting days during the pandemic are considered days worked in New York. You're still going to pay tax in New York unless your employer established a bona fide employer office at your telecommuting location. So that's important to know. Again, there's no New York City non-resident tax, but there is a New York State tax. So I just wanted to say that. I'm sorry. Go ahead, introduce.
Thank you for that clarification.
All right, Karen, you owe me 2 minutes.
Go for it.
So Eric, I want to hear, what is your solution?
Okay, well, thank you. And great job, Andy. As you hear Karen, we listen to Karen, we listen to Andy, and I've been dealing with this for years with my clients. It just reiterates the complexity and of what's going on. So, we're in weird times now, post-COVID and the markets, and we have a big tax reform coming up that we're all hearing about. It's going to get a lot more buzz. That's a federal level, but I believe in really helping my clients save taxes. And if we know the federal government is increasing income taxes, capital gain taxes, just without getting into all that, there's a lot about to happen. Every tax dollar matters. And when we talk about tax planning, residency audits, residency planning is really a big part of it today. And so that's really where we took the time as an advisor for 35 years, helping clients. We've been dealing with this for so long that we really, built out a platform that doesn't exist today. And it really is there designed to help things not fall through the cracks. And I'm going to, there's no way I'm going to be able to express it all in 10 minutes, but I'm going to do my best. And we'll talk about, at a later date. But what we're talking about is, when we talk about the domicile planning, change of domicile planning, which is what we call it, it requires time. It really requires the time to do the proper planning. And so I just want to reiterate that. I'm going to just share my my screen here. And so I think there's, as we know, there's a misconception out there. At least we know as professionals, there's a misconception out there that all you have to do is change domicile is spend 6 months and a day, or as we just heard, 183 days in Florida, out of New York, and change your driver's license. It's just not true. And that's why we named our company 6 months in a day, to really capture that. The audits we talk about, Karen just talked about all about the residency audits. And we know it's very complex, it's invasive, it's time consuming, and you really need to know the rules and the playing field. We just heard from two experts that talk about the rules, the regulations, the complexity, the requirements, and the New York law, if this and that, all the stories are out there. And the question is, what are you going to do? So now you could say, a lot of people say, well, it's not going to happen to me, or they say, I'm totally prepared. I have a spreadsheet. I know what I'm doing. But if your plan is to pay less taxes in New York than a prior year, or to pay no taxes because you changed, quote unquote, you changed your domicile, A, you're a target for sure. B, the state has all of your data, and the state has the technology to find you. And that's a big deal. And I'm going to cover that in a minute, because Big Brother in New York State is truly watching you and you don't realize it. So remember, the state of New York has no intention of allowing you to take their tax dollars without a fight. And that's how they view it. It's their tax dollars, especially in our post-COVID world where states have major budget deficits. So it's a battle. It's a battle between the state and the taxpayer. And who's going to win? Well, it really depends on two things: how aggressive the high tax states like California, Illinois, New Jersey, and most importantly, New York will be, and then how prepared are you for an audit? And the reason I say most importantly New York is because they've been conducting the residency audits far longer than any other state. All right. New York has the most case law by far than any other state, which is why other states are looking at New York. New York has over 300 auditors right now in this department and hiring more as we speak. So, you really have to, be aware and pay attention of what's going on here. And so another fact is that New York hired IBM over 10 years ago and built this system for them called KISS. And it's a selection system. So it's real. IBM was so excited about it. They wrote an article on it, and you can see how predictive modeling improves tax revenues. So what does it consist of? And I don't want to get into all this, but we spent the time as we've built our software, reverse engineering this, understanding the audit process in New York, understanding what is their rules. So KISS, you see at the top here, KISS's primary objective is to incorporate mathematical business intelligence models to select, prioritize, and manage work. I'm not going to get into all of it, but it's event-driven, as you can see here. And they have it all. So when they cross-reference your tax return with a fishing license, with your driver's license, with your residence, all those things are in play. And so if New York is watching you, who's advocating for you? Who's advocating for the taxpayer? And that's our point. That was why we spent the last year building software and this whole platform called 6 Months in a Day, because, you need somebody to advocate for you. If you're not armed and prepared for battle, you're going to lose. And this is an amazing statistic. This is true. This is the facts that in 2018, this is pre-COVID, back taxes owed to New York, $273,000 average. It's a big deal. It's a big deal. So how do we combat this? We have built this white glove service. And we have a process. So I'm going to share with you our process in a minute, but you see this, the automated checklist. So you can go out and, there's a lot of law firms, and on the internet, you can get all these checklists that have it. So what we did is we took and we consolidated everything and have over 220 change factors. We call it change factors. Karen just talked about the 5 primary factors. There's the ancillary factors, all under New York State law. Okay, that's all built in our software, in our system. So not only do we have a checklist, but it's automated, it's digitized. We've helped build the strategy. We have something called the Domicile Change Playbook. We have an assessment tool. What's your risk? What's your assessment? I'm going to show you. Residency coaches, change advisors, really just there to advocate for the taxpayer. And this is not just New York. It could be across the board because other states are looking at New York. So we have all 50 states covered. It's not just moving to Florida. It could be to Texas. It could be to Nevada. I mean, most of our clients are in New York, and Florida, so we focus there. But you need a process. If you just think it's that simple, you're going to lose. So our process is simple, 3 steps. 1, audit risk assessment, right? What is your audit risk? 2, what are your key change factors? Okay, so if there's over 220 of them, which ones apply to you and which don't? And then building out your playbook. What is your playbook? What is your strategy? And that's all done up front, but it changes. Life changes, things change, especially when you look at this audit, it's digging in. Karen talked about the primary factors, family, and it's very invasive. So over time, we maintain activity timeline, and then on the side over time, the readiness adjustments, and we really go around and around based on your domicile change date. So the factors affect, as we've been talking about, your family, your personal, financial life, business life, depending on what, and then inside each are drilling down all the way. So what I wanted to share with you is, if we know these are the 5 primary factors, and Karen did a great job of drilling down in these, but it goes so deep. So when you talk about your home, or your family, and Karen talked about, okay, your home, what's the square footage up north versus here? What's the value up north over here? Your family, all the different things are built into our platform. It's a decision-making process. Most importantly, I've worked with a lot of business owners. If you own a business up in New York and you are thinking about exiting one day, well, you own a place in Florida and you're doing a snowbird thing, well, you need an event. And before you do that, you really want to figure out a strategy on how to migrate down to Florida. And when you do exit, maybe you don't have to pay tax on the sale of the business, or maybe you have an allocation of income strategy like Andy talked about, Karen talked about. So these are all things these are the 5 primary under the domicile test, critical. But then you have all these. And these are all the ancillary, these are just a taste, without getting into it. Any of these can tip the scale, really can tip the scale. So the real question becomes, what are you really doing? Because the question is, A, have you severed all ties to New York? And that's where they catch you up. So the ancillary factors are really important. And what we do here, this is the SIXMAD score. SIXMAD is 6 months in a day. And what we do is we compare it to, a FICO score, just like a FICO score where you're on a scale and up to 850. Our scale for 6 months and a day is up to 690. So what is your SIXMAD score? How prepared are you? What's your risk level? And as you go and check off each of the items, those 220 items, or those that apply to you, you go from the red to the orange to the green. And so how long will that take? It's up to you. If you have children in high school up in New York and you want to move to Florida, could take longer. I mean, we have story after story. So we've built this based on algorithms, really reverse engineering the law tied to this, and really trying to help people get past that finish line. So again, we have the software. I want to just real quickly, this is just so you can see, this is the software. I'm not going to get into it. You'll have the opportunity for a free 15-minute phone consult with us if you want to see more. But I want you to just see that, this is tell us about yourself, blah, blah, blah. But here, the 5 factors auditors look for. This is it. Okay. Home, business, time, under business. What are your patterns? Employment. I mean, it gets into all the details to really help you strategize. So it's not just the software, it's the strategy tied to the software. And then you go here and we talk about the KISS database, and we talk about all premium notices, financial, moving tests. And in each one, you drill down and you go more and more. Doctors, therapists. After this process, we're all going to need therapists. Without getting, I mean, you can go on and on, but at the end, when you fill it all out and you say, okay, I'm ready to start. Here's my score. Here's your SIXMAD score. and now you go from there. And also we have your plan. We have a network in Florida, lawyers and, different people that may need some, where you may need some help doing that. So we are the cost of the whole platform, the service, the software, everything is $5,000. And today we're providing a 20% discount for the next 30 days, whoever signs up. And what I want to just draw to do so, you can go to our website, 6monthsinaday.com, and here there's a quiz to see your probability of passing or failing. It's very simple, non-invasive. We have a video you can watch. You can read some blogs, an ebook. But if you want to get started, schedule a call. And you click that and you schedule a call with one of our people, and we'll walk you through it, answer the questions. But I can assure you that for those of you that will have, if you're making more than $100,000 to $200,000 a year, they're watching. They're here, they're watching, and we need strategy and defense. And we're all here, myself, Andy, Karen, to help. Thank you.
Fantastic. So your software is kind of a first step where people can come to you and they can find out where they are on the scale of where it's safe and where you could end up owing a lot of money. And then, working with Karen and Andy specifically on their issues and hurdles to be able to overcome. Is that right?
Correct. And just, you really need to plan in advance and spend the time. It's just, as we said, it's just not that easy.
Terrific. So really important to plan and to have the right team in place of knowledgeable people who can make sure that nothing is missed. Thank you so much for that. And thank you for offering everyone a 15-minute phone consult and the 20% off for 30 days. That's amazing. I hope everyone takes advantage of it. I did share Karen, Andy, and Eric's contact information in the chat, but as I said, I will also send it out in an email tomorrow, so you'll have all of that as well. But I do want to jump to some questions. Our attendees have some great questions I'd like to get to. So
I see one. If I start at the bottom and work our way up, what about a mental health professional who permanently moves out of the state, I guess to Florida, but meets with New York clients by way of telehealth? I think that's really key because in this remote world, the world is doing everything by Zoom. So are you a licensed professional in another state? I mentioned earlier that earlier today, we were on a Zoom with a New York attorney who is not licensed in Florida. Well, are you licensed in Florida? Are you licensed in the new state? There is a case out there where a guy was a realtor, had a real estate license in one state, but was practicing in another, and that's a problem. So you have to establish all the right credentials in the right place. And again, have proof that you're properly licensed there, and then maybe establish an entity and a business location, and then you could telehealth wherever. But Andy could tell us about New York source income. Would that be considered New York source income?
No, not if the service is being provided sitting in another state.
So there you go.
But again,
so
it would depend. You could plan that properly, so it would not be New York sourced income.
Right. So you have to plan in advance. Okay.
Right.
So someone asked about getting a copy of the questionnaire. It's the same questionnaire that they've been using all these years for field audits. They ask very basic questions, and I would be very hesitant to fill it out, just to tell you that up front. Because the second you put documentation, something in writing before you check with your professional, they're going to use it against you.
Yeah, and I agree. I strongly encourage not to fill it out. Bring that right to whoever is whoever's advising you. They need to understand this specific, because there's a lot of advisors. I work with a lot of accountants and attorneys, as do Andy and Karen, and there's a lot of misguidance out there. So before you submit anything back, especially that questionnaire, once you do that responsiveness of you to them, we would wait till let them come knocking.
And someone asked if we'll share the slides. I'll share the slides. I saw a typo as it went by, so I had someone just update it and send it to you, Elizabeth, but we'll send it out. If you give us the list of the attendees, I'll send it out with the new updated typo fixed.
Perfect. Thank you.
There were a couple of questions regarding New York sourced income. So if you're receiving a pension, even though you were a New York City employee for your career, but then you did move to Florida and you're still receiving, like a New York City fireman who retires to Florida, that's not taxable to New York, nor are stock transactions where the sale date is after you are no longer a New York State resident. So if you have built-in gains on a stock, move to Florida, it's a done deal, no questions, and then you sell that stock, the capital gain is in Florida, not in New York.
Thank you. Thank you for that, Andy. We have a question from Robert, who's planning to move to Tennessee in 5 years when his wife has a 20 years in pension and then do Roth conversions in Tennessee. However, the kids are going to be forced to stay in New York because of Excelsior scholarship rules, and they can't sell their house because of it, but they don't plan to be in New York. The house in Tennessee is going to be cheaper and then one in New York because they do not have cash until house is sold. So where do they on the spectrum?
So if the kids are staying in the house, it's going to be a question of proof. So who's writing out the checks, or in these days, you know, you're not necessarily using a check. Who is paying the expenses on that house? It doesn't really matter who owns the house, even if you, quote, sold the house to the kids or put it in a trust. If you have, again, unfettered use and access, they may say you're still in New York, but can you show that you've changed your pattern? You know, are you in this new location? Have you joined the local church or temple? Are you active in the community? Is there a homeowners association that you're involved with? What else have you done in the new place? You have to show, again, by clear and convincing evidence, that you have moved. So it's okay to continue to own that house. Are you coming back on a regular basis? Are you staying in the master bedroom? Are you still there? You know, how do you prove all of this? You have the burden.
Don't do it alone is my answer to the question. Reach out to the folks here. I said, don't do it alone. It sounds like it's complicated.
Exactly.
Paul had another question about with moving to Florida. If he moves to Florida and sells his house in New York and spends 6 months and a day in Florida, but work for a Connecticut firm, how does that work? Because he will be going to up north and will rent or stay at a hotel or a family's house in Rhode Island. Again, how does that, you know, it sounds like there's still a lot of hoops to jump through, not just the 6 months in a day.
Well, that sounds like more a source. So if you lived in New York, moved to Florida and working in Connecticut, the time worked in Connecticut, if the employer handles it properly, will be Connecticut sourced income, and you'll pay Connecticut income tax on that, even though you're a resident of Florida.
Got it. And, you know, someone asked, which I think is a wonderful way to kind of close the time together. Someone said, you know, is this really a big problem in New York?
Oh my God, a big problem. It takes up a lot of our time, and they're looking at deep pockets. And believe me, once they get you, it's a hassle, because now you got to go through 3 years worth of where were you every single day? Can you prove where you were every single day? What happens if you didn't write something down? You don't know where you were. You know, again, I see now with Google Maps, it does show you where you were every day, but how else do you prove it?
The point is,
not always so accurate.
Absolutely. I think the one thing that we learned today for sure is that it can be difficult and that it can be complicated, and that to be able to have the right team in place to assist you and make sure that you're doing the right thing, you're making the right plans, and you're able to overcome these hurdles is really critical.
Right.
So,
the presumption is against you. You know, usually you're innocent until proven guilty, but it's really, they assume you're guilty here.
Absolutely. Well,
And you have to show otherwise.
Karen, Eric, Andy, you really were so generous with your knowledge. I thank you so very much for sharing all of that with us. I know I've learned a ton, and I'm going to think about that and make sure I speak to all of you before I move out of New York. And please, all of our attendees, I want to thank you so much for joining us today and learning. I know there's so many more questions. That's why I'm going to give you all their contact information. You can get in touch with them, and they can answer your specific questions and help you to save money when you're leaving New York.
And no, they don't have to be consecutive 183, more than 183 days. They don't have to be consecutive. And there are some minor exceptions if you're out of the country a certain amount of time, but we're not going to get into that now.
Karen is so amazing. She doesn't want to stop giving you information. I absolutely love it. Thank you, Karen.
All right. I love the topic. You know that.
I love your passion for it. And that's what's so wonderful. We have experts who are passionate about what they do. So thank you to our attendees for spending some of your day with us. We really appreciate it. I wish you all to stay safe, stay healthy. You'll get the recording. You'll get all the contact information. And we'll look forward to seeing you on a future webinar. Have a great day.
Team. Thank you, everybody.
Thank
I also
you.
learned so
Thank
much
you.
from both of you. Thank you.
Take care.
Bye.